does holding your investment position leave you sweating? With Endowus, invest with clarity. Proven strategies, unbiased advice, low fair fees. Endowus.
Good afternoon, everyone. My name is Hugh, Chung, Chief Investment Officer at Endowus, and I'm joined by my colleague Yulin, who's the Senior Investment Lead at Endowus. Thank you for your time today. We will be going over our 2025 portfolio performance review with a focus on the fourth quarter. Next page, please. Going through our usual disclaimers. So very quickly, a lot of you are clients of Endowus, but just reminding what we do at Endowus, we're a conflict-free advice, institutional access, and low fair fee platform that strives to give you institutional-like solutions to our individual investors. Next page. So we do have some of the most prominent shareholders as our shareholders, like UBS, Citi Ventures, and MUFG, but most of our cap table is still owned by the employees. Next page. So without further ado, very quickly going through the fourth quarter of 2025, which already seems like a distant memory, but I think it's worth going through what had happened in the past. Next page. So as you can see, in 2025 overall, after it dipped during Liberation Day in April, we saw a strong recovery up till third quarter and early part of fourth quarter. And global equities still managed to return about 3.1% in Q4. But as you can see, the level of risk on mode had actually tapered off towards the end of the year with a lot of uncertainty around valuations in the equity markets, as well as concerns over geopolitics. And it was that same period we continue to see the rise of the gold price and other parts of commodities that have been volatile, but also has increased in price. On the other hand, fixed income was more steady, and it had been quite steady throughout the whole year. And so you can see that contrast in asset class performance in Q4. Next page. So first, looking at equities, you can see that for the whole year in 2025, the best performing region was Asia ex-Japan equities, with the regions like Korea delivering more than 80% for the year. And then emerging market equities overall has returned about 30% for the year. If you look at Q4, Japan equities and Korean equities led the region. Japan equities delivered 8.6%, followed by Europe and Asia ex-Japan. 2025 was the first year in a long while where non-US equities, and particularly Asian ex-Japan equities, outperformed the US market by a wide margin. Next page. And when you look at the sector as well, compared to 2024 and 2023, where the IT sector, the tech sector was really driving performance, in 2025, the best performers were sectors outside of tech, including materials, which was on the back of the strong performance of gold and then gold miners. But if you look at Q4, other laggard sectors such as healthcare have also started to perform, where we saw widening of sector performance from just tech and just US equities. Next page. So I'll hand it over to Yulin.
Great, thank you, Hugh. I will go through the fixed income market briefly and highlighting what happened in the last quarter of 2025. So the two charts here shows you the picture of rates movements as well as credit spread movements for the full year and Q4 2025. On the left-hand side, we can see the movements of US Treasury curve from yellow to blue represents the full year movement. And this is really significant because the yield curve shifted downwards, which means that bonds with duration exposure, especially on the front end, where the yield shifted down more, would have benefited from this movement. Another really significant thing that happened in both Q4 and 2025 was the steepening of the yield curve. So the front end of the yield curve can move differently to the longer end because they are anchored by different factors. So the front end actually shifted down more, whereas the longer end, especially the really long end, actually increased. So yield curve positioning was a very important differentiator between different fund managers in fixed income space in 2025. And in moving on to credit spread, overall, it was pretty steady with some intra-year volatility that followed the equities market. And in Q4, we can see that there was, again, very little change. Actually, the high yield spread even compressed slightly in Q4, whereas the investment grade spread, that's represented by the blue line below, widened slightly. But overall, for those who had exposure to both duration and credit, would have benefited from both exposure. Next page, please. So this is a similar chart, but for fixed income sector performance. So both, I think emerging markets, that was a strong narrative for fixed income market as well. In 2025, we saw that there was improving fundamentals in emerging markets, and as US dollar experienced weakening, that actually benefited emerging markets currencies and economies as well. So in Q4 and 2025, EM debt actually dominated the performance. On the other hand, actually overall, the broader fixed income market delivered positive return. And for example, the longer duration global investment grade bond sector delivered the second best performance for the full year. So that wraps up the 2025 market review, and we will go straight into the portfolio performance review, and I'll hand back to Hugh.
Thank you, Yulin. Maybe next page. So this is the performance of our flagship cash portfolio. And I'm very happy to report that the numbers were actually quite strong for both Q4 and for the whole year. So if you look at the very aggressive equity, 100% equity portfolio, the portfolio delivered about 3% for Q4, which is in line with the global equity index. And also for the whole year, it was also about 15.1%. But if you look at the second half of the year, the performance of our equity sleeve of our flagship has actually outperformed that of the global equities market. And I think it's because the value sleeve, or the value tilt of the portfolio, as well as the emerging markets overweight that we have in our portfolio, really benefited the performance. And on the fixed income side, it continues to outperform every single quarter the global ag index. So in Q4 as well, the very conservative part of the portfolio, which is 100% fixed income, deliver about 0.9% versus the global ag of 0.1%. So if you look at a balanced 60-40 portfolio, it delivered 2.2% for the quarter, compared to the global 60-40 index at 1.8%. And for the whole year, the balanced 60-40 delivered 11.1 versus a 60-40 benchmark of 10%. And I think it's worth reminding our clients the kind of philosophy behind our flagship portfolio construction. It's really a combination of a systematic manager called DFA, Dimensional Fund Advisors, as well as two low-cost passive equity index providers in iShares and Amundi. And then on the fixed income side, a vast majority of the fixed income side is managed by PIMCO on active fixed income. And one of the basis of the systematic strategy that we have is where we harness what we call factor premium. And Dimensional has been running these strategies for 40 plus years with a tilt towards value, small cap, and profitability. And I think 2025 is a great year where this really shines, because a lot of clients have been worried about the concentration in the market over US tech in particular and growth names. And this systematic approach towards harnessing, factor premiums in a diversified way has really shined through, and it's showing in terms of performance. So I think this is a good reminder on why we construct our portfolio this way and can generate positive results. So next page. Similarly, for our CPF portfolios, the equity component of the CPF is reasonably similar and has delivered very similar results. The fixed income side, however, is a little bit different, given that some of the constraints that we have with CPF. Our fixed income part is a little bit more geared towards Singapore bonds. And therefore, depending on the performance of the Singapore bond market, the quarterly performance can fluctuate, and therefore the very conservative portfolio in Q4 underperformed global ag, given its overweight to Singapore bonds. However, if you look at it on a full year basis, you'll see that the conservative portfolio has delivered 3.1% versus global ag at 2.4%. And similarly, the balanced 60-40 portfolio delivered 10.4% versus 10% for the index as well. So CPF it has also been doing, or our flagship portfolio with CPF has also been doing, what it was supposed to do for the quarter and for the full year. So I'll hand it over to Yulin to cover the income portfolio.
Yeah, thank you, Hugh. So just a reminder that we have 3 different versions of income portfolios designed with specific objectives, and they have different asset allocations and risk levels as a result. So stable income is 100% fixed income portfolio, and it is primarily investment grade fixed income. So in terms of the risk spectrum amongst income portfolios, it will be the lowest. Then higher income is designed to really cater to both the income needs and a little bit of capital growth if you can take more risk. So this has 20% equities allocation to fulfill this particular objective. And future income is the highest risk of the 3, with 60% allocation to fixed income and 40% to equities. So that is the context. And on both a Q4 basis and full year basis, you can see that the total return of the portfolios align with the risk profile of the portfolios. So I'll dive a bit deeper into each of the portfolio. So in Q4, stable income portfolio outperformed the Bloomberg Global Aggregate Credit Index, and this is primarily supported by the active flexible income funds, in particular the PIMCO Income Fund. And it also benefited from its slightly overweight position to emerging markets debt. For higher income in Q4, again, the fixed income component outperformed the credit markets for similar reasons to stable income. And emerging market, and for its equities allocation, it actually outperformed the equities market as well. It benefited from the emerging markets and Asian equities overweight. The outperformance in the equities market was slightly offset by the underperformance by the real asset sector, which was impacted by the rates expectation. And but that's the important component for income generation. Hence, it was included there. And future income delivered really strong return, 1.5% in Q4. Again, the fixed income component mirrored the stable income's outperformance. Its equity component slightly underperformed the equities benchmark, primarily because of exposure to low volatility style. So we know that Q4 was again driven by, kind of the growth names, and the low volatility stocks names started to underperform kind of second half of the year. So that hurt the portfolio a little bit. But it was this underperformance in equities market was partially offset by its tilt to quality style and also European equities, which outperformed in Q4. So on a full year basis, stable income and higher income outperformed their respective benchmark, while future income compared to 40-60 benchmark performed roughly in line. And I wanted to also talk a bit about the payout. So the target payout for stable income stays at 5 to 6%, and for future income, it stays at 3.5 to 4.5%. It's important to note that it's really important for us not to just be fixated on the income. We should actually also look at the total return, because ultimately you get everything in terms of total return, and income is just part of your total return that's being paid out. So for example, future income seems to have a less headline yield, paying out 3.5 to 4.5%. However, you keep more of the total return for your future growth. And that's why it's also called future income. It's for a dual objective. And in terms of higher income, there was a revision of its payout target downward from 5.5 to 6.5% to 5 to 6% in September 2025. And we explained the reasons for this revision in our monthly performance review articles. So the reasons were twofold. Firstly, the recent increase in the hedging cost between Singapore dollars and US dollars has caused certain fund managers to lower the payout target. And that is coming from a good place, because you either take the hedging cost from your income or from your capital. So some fund managers decide that they will net the hedging cost partially from income. That lowers the income, but it helps with capital growth or preservation in the long term. So this impacted overall payout levels across all three portfolios. But this in particular has caused higher income portfolios' payout yield to dip below the prior target payout range. So that's the first reason. And the second reason is the broad macro backdrop. In light of the prevailing interest rate cycle, which is declining, we believe it's only prudent to lower the current target payout range of the higher income portfolio, and we will do so for the other two portfolios when needed. So someone might ask, but then now the higher incomes payout seem to be very similar to stable incomes payout. It is true, and we recognize this, and this is also because of a very specific dynamics in the fixed income market. So just to explain a bit more, the investment grade flexible income funds, they are able and continue to be able to generate income that is akin to high yield funds in the current environment, where the high yield spreads are particularly tight. So that means if you invest in high yield, the income you get is only slightly higher than what you will get from a multi-sector investment grade fixed income portfolio. And in light of this, we are comfortable with the higher income portfolio generating an income level that is similar to that of stable income. Despite higher income taking a bit more high yield risk, we don't want to stretch for yield in this environment by deviating and increasing from the overall risk target of this portfolio. And again, coming back to the point on total return, it's important to note that higher income portfolio has delivered better growth in terms of total return than stable income. So for example, in 2025, stable income delivered 6% total return, which will be mostly paid out as income, whereas higher income delivered 7.6% return, which means you would have seen more than 1% capital gain after receiving the income. So that is the overview for income portfolio. Now let's move on to the ESG portfolios. Next slide, please. Yeah, so in terms of its 6 risk ratings, but it provides investors diversified exposure to the sustainability themes. And it's particularly important if you are a value-driven investor who want to be, a steward of the environment and society in the long term through investments overall. In Q4, the 100% equities portfolio broadly tracked the global equity market. So the top contributor includes Schroeder Global Sustainable Growth Fund, for example, which benefited from its quality growth orientation and positive stock selection. And on a full year basis, the equities portfolio underperformed the broad market. And that's because there is a tilt, for example, to small cap and quality in emerging markets, which hurt over the year. Small cap actually underperformed, especially in light of the mega cap tech rally in the China space in Q3 and Q4. But I think the overall picture is that the portfolio continues to provide exposure to the structural sustainability themes while maintaining a financial discipline. So it's broadly diversified, and it still delivers financial results, although sometimes it can have a relatively higher variability versus the market because of the certain tilts that the portfolio has to make in order to be more tilted towards sustainability. And for the fixed income side, the Q4 performance was broadly in line with the Bloomberg Global Aggregate benchmark. On a full-year basis, the portfolio really outperformed. So you can see that the portfolio delivered 5.2% versus the benchmark 2.4%. Again, the active management by the fund managers within this space really helped to contribute to this outperformance. And this demonstrates that an ESG-aligned fixed income investing can deliver competitive, and in this case, even superior returns over a market cycle. Next slide, please. So moving on to our factor portfolio. Again, this is a globally diversified portfolio, but this is adopting a particular, school of thought in investing. I think Hugh briefly mentioned during his review of our flagship portfolio, factor and systematic investing. And that is you gain broad exposure to the markets, believing that market is generally efficient. However, this school of thought, which is actually backed by, the Pharma French, the Nobel Prize winning economists, believes that there are long-term factors that offers you positive premium in the long term. And in the equities market, that will be, value and quality and small cap. So if you tilt your portfolio slightly to the cheaper companies, higher quality companies, and smaller cap companies, over the long term, you outperform. And in the fixed income side, it is the tilt towards credit premium and term premium. So that is, you kind of look for the steepest part of the curve, both on the credit spread curve and on the rate curve, to harvest that premium in the long term. And that's exactly what the portfolio does, and it's supported by the dimensional funds. So in Q4, the equities portfolio delivered 2.3%, which underperformed the benchmark slightly, and this is because of its tilt to small cap, which lagged in Q4. On a full-year basis, it's a year that demonstrated both challenges and reward for factor investing across different quarters. So you can see actually Q1, the portfolio outperformed because value stocks actually held up pretty well in the sell-off. And in Q2, it underperformed in the recovery, and Q3, again, it was a good relative quarter. It outperformed, driven by exposure to emerging markets. And also emerging market small cap actually helped a little bit in Q3. I think the full year picture really illustrates the classic factor investing pattern. The premiums are long-term in nature and require patience through periods of outperformance and underperformance. In terms of fixed income, overall it performed, it slightly underperformed the benchmark in Q4. And this goes back to what I mentioned previously on yield curve steepening. So there are two parts of the portfolio. There's one part of the portfolio that is longer duration, and that could have hurt the portfolio because the longer end actually went up. But then the shorter end of the portfolio in the fixed income would have provided stability and offset the underperformance on the longer end. And on a full-year basis, the fixed income portfolio outperformed, with the outperformance in Q2 and Q3 in particular, offsetting the underperformance in Q4. Okay, let's move on to our satellite portfolios. Again, I wanted to just set the context for the satellite portfolio. So previously, we were primarily discussing kind of the core portfolios that meet your different long-term objectives, either growth objective or income objective. And at Endowus, we adopt this core satellite approach, meaning that we believe that most of an investor's long-term capital should be allocated to core portfolios that's diversified and tailored to your long-term needs and goals. But if you have, conviction in certain sectors, you can express that through a satellite position around your core position. So this is how we designed our satellite portfolios around 4 different sectors and themes. So let's go into the first one, China equities portfolio. In Q4, it's actually a great quarter for our portfolio, and it really showed how diversification really shines through in periods of volatility. So Q4, the overall China market entered a period of consolidation after explosive growth in Q3. However, this consolidation was really driven by the tech names, and our portfolio was much more diversified and actually was very resilient. So we were down negative 0.2% versus the market, which was 7.4%. And on a full year basis, again, I guess you can see the pattern because our portfolio, so the index has a lot more mega cap names, more than 60% is in the mega tech names, whereas our portfolio is more diversified across the market cap and sectors. So it doesn't, it wouldn't capture the full upside if it's driven by the mega tech rally. However, on the downside, for example, in Q2 and Q4, it was much more resilient. Moving on to, I will talk about real assets last because that's the portfolio that is supposed to be actually more uncorrelated to the equities market, whereas the other 3 are primarily equities portfolio. So I will jump to megatrends next. So megatrend Q4 was a very strong quarter. It outperformed the global equity benchmark. And this is driven by 2 single theme funds in the portfolio. The first one was the biotech fund by Janus Henderson. There was some positive development there, and the fund experienced really strong growth. It was more than 25% in the quarter. And another theme that drove the performance in Q4 was climate change. So the GMO Climate Change Investment Fund was up, not as much as the biotech, but up by 8%. And that was driven by a clean energy rally. Over the full year, it was a volatile but rewarding year. And single theme funds, biotech, climate, and AI and robotics were the biggest full year contributors. However, the single theme funds also exhibited higher volatility. So the diversification across the multiple themes really helped to cushion that volatility. And the full year story really highlights the value of thematic diversification. So the different themes actually led at different times. Another example was in Q1. Q1, actually, the AI and tech theme went down a lot. Biotech went down a lot as well. But the diversification to agriculture theme helped to add resilience to the portfolio. And another interesting thing to notice for a thematic portfolio is that the concentrated single theme funds did drive the bulk of the returns, despite being only 22.5% of the portfolio. So this demonstrates a symmetric upside potential of thematic investing. And next, I'll move to technology. For technology portfolio in the last quarter, it underperformed global equities and tech index. And the primary reason is because of an underweight to semiconductor and equipment names and some stock selection misses in the portfolio. On a full year basis, the portfolio outperformed global equities but trailed the tech index. So there was some sell-off in the first quarter, and we were kind of in line with the market And the second quarter was the most interesting one because the second quarter we actually outperformed by quite a lot. And that was the quarter where stock selection finally worked in tech. And the active managers picks actually really helped with the relative performance. And on a full year basis, the portfolio is much more balanced in terms of its construction between mega cap and large cap. And it means that it wouldn't fully participate, for example, in Q3 in the upside. But again, I think with the broadening out of performance, from just the max 7 to a bit more like along the value chain of AI, and we're seeing slight broadening of performance within the tech sector. Hopefully, the active selection by the fund managers will eventually play out when the market is a bit more back to fundamentals. All right, okay, the last one is real assets. So the real assets portfolio is designed to provide investors with exposure to, real assets. And what are real assets? Commodities, natural resources, equities, listed infrastructure, and real estate equities. So Q4 was a pretty positive quarter with about 0.9% performance. And what contributed to the performance was primarily precious metal exposure through the 91 Global Natural Resources Fund and the PIMCO Commodity Real Return Fund. There was some headwind, as already mentioned before, in listed infrastructure and real estate sector. And on a full year basis, actually, we can really see the correlation playing out. So across the 4 quarters, the real assets portfolio delivered positive return, while the equities market went through ups and downs. And Q1 was really a standout quarter for the portfolio. The portfolio was up 2% when global equities fell 3%, really demonstrating its value to diversify your equities portfolio. So commodities was the best performing asset class in Q1. And in Q2, again, stable positive return. The portfolio, it's important to highlight the nuances. The portfolio was actually more defensive in April. It experienced a smaller decline versus the equities market pullback. And in Q4, all underlying funds contributed, and Q3, all underlying funds contributed. So yeah, I think the full year, the portfolio delivered nearly 10% while providing meaningful diversification benefits to your other holdings. Now let's move on to the last suite of portfolio that we will cover. That is our cash smart portfolio. It's 3 risk profile. So we have cash smart secure, and you can see it's the shortest duration. Then we have enhanced with slightly longer duration, and cash smart ultra with the longest duration within the cash smart suite. So investors choosing between the 3 portfolios should really think about how much time you have before you need the liquidity and choose accordingly. And in Q4, all 3 portfolios delivered positive return, although returns kind of converged across risk levels. On a full year basis, Secure delivered 2.3%, Enhanced delivered 3%, and Ultra delivered 3.8%. So returns aligned with the risk levels across the full year, despite quarter-to-quarter variability. And I think that really demonstrates the portfolios performing as designed, Secure delivering the lowest but the most consistent return. Enhanced was in the middle, and Ultra delivered the highest return with more variability. Another really interesting thing to notice across the quarterly performance is we can see the performance reflecting a declining rate environment. So it started the Q1 the strongest, and by end of Q4, as the rate has fallen, the portfolio, because it's really short duration, reflects that more quickly. So yeah, I guess looking ahead, investors should really review whether this is something that you are comfortable with. I know that some investors are quite cautious and are sitting on a lot of cash, but there is also risk of sitting on this cash if you're not participating in the market, as the short-term yield is declining and there is reinvestment risk. As the existing cash holdings expire, they have to deploy into the lower yielding holdings, which will reduce the potential for your cash holding. So something to think about as we conclude our portfolio performance. Then we will go through a little bit of the overlook and investing principles as the next section, and I'll hand back to Hugh.
Thank you, Yulin. So let us go through a little bit of the market outlook, and I'll tie in some of the Q&A that we've been hearing, which is quite relevant. So next page. So this is a page showing the performance of different markets in 2024 and 2025. And the green part that you see is really the earnings growth. So what is driving returns in these markets, whether it's growth, whether it's multiple expansion in gray, and then other parts such as currency in purple. And the first thing you'll see is that Japan, Europe, emerging market, et cetera, have all outperformed US in 2025, like we described. But what's interesting is that almost the entire part of US performance is coming from earnings in green, as you see in 2025. This is different in 2024, where a big part of the returns, and US was the best performing market in 2024, came from multiple expansion as well. And you can also see the currency deviation. So what we're trying to show here is that obviously it's very important to diversify because it's very difficult to understand which markets will be outperforming, underperforming, but there's also different parts of performance. As you can see in the non-US parts of 2025, a big part of it was multiple expansion as a catch-up to the US, and then a lot of it was currency given the depreciation in the US dollar. But I think what's really important to highlight is that again, US growth came from actual earnings growth, and as long as earnings growth is intact, it is likely to be a core allocation despite the valuation being quite high. And I think this ties in with one of the questions that came through, which is, how do you, particularly a lot of clients that are in Singapore worried about the US market and US dollar asset exposure are asking for ways to, I guess, not have exposure to US and have global exposures. And my first response to that is that is actually quite difficult, right? US equities is about 60% of the entire global equities space. It's home to some of the most innovative companies, such as the hyperscalers and so on. And a lot of these hyperscalers are actually global companies by nature that happen to be listed in the US. So the risk of completely not having these companies in your portfolio, even though it's very concerning for different reasons, is very, very high as well. So you have to understand that just by taking something out does not actually reduce your risk. There is, particularly when it's driven by actual earnings, I think it's very important to think of it as core allocations. Having said that, we do have certain funds in our FundSmart platform that give you access to non-US developed market and non-US equities. There are also certain funds that have SGD hedged exposures, particularly if it's income generating or thematic. But we, as a general rule, do not like hedging our equity exposures, because it's very volatile and very difficult and expensive to hedge, and B, there are a lot of natural currency hedges within equity exposures that make it first very nuanced, but also you're actually getting exposure to different asset classes by the currency exposures you have. So actually hedging it doesn't make sense. So over a long period of time, we think that it still makes sense to have the local exposures of different local jurisdictions. Maybe going on to the next page, it kind of ties in with what I was explaining, again, the fear of the US market and the potential AI bubble because of the CapEx that we've seen from the AI hyperscalers over the last 12 to 18 months and the subsequent increase in share price of some of these sectors. But I think what's really important to highlight again is that the AI adoption rate has also been equally strong, and therefore the CapEx has actually been more or less validated. And also a big part or the majority of the CapEx is coming from free cash flow as opposed to debt financing, which has really been the case during the bubble. So I think the situation is quite different. Again, if you look at certain numbers, the growth that's coming out from US markets in particular, let's say close to 3%, and you look at the labor growth, it's actually quite lackluster. So a big part of the growth is not driven by labor growth; it's actually driven by productivity, which is really a byfunction of the AI adoption that we've seen. So if you think about the fact that, again, AI is driving not only the AI stocks itself, but productivity overall, particularly in the US markets and now in global markets, again, it goes back to the question of should I be avoiding US asset exposure in my global portfolio? So again, the valuations, depending on how you look at it, are quite expensive for certain sectors. But again, I think there's a lot of fundamental tailwinds that are happening which justify some of that, and therefore it's very risky to take out all of this exposure in your portfolios. So I'll hand it over to Yulin to go over a few other parts of our outlook.
Yeah, thank you, Hugh. So going back to a more macro picture, this is a chart that we show almost every quarter to update everyone in terms of how the Fed is expecting in terms of the growth on employment rate, how they're seeing inflation, as well as the future rate cut trajectory. So as you can see in that small box, the Fed in its latest meeting is still relatively comfortable with the GDP growth. It's at the projection is at quite healthy level, above 2%, and inflation seems to be reasonable as well as unemployment rate is not shooting up. So this is consistent as well with, I guess, what we have been hearing from a lot of fund managers in that the growth picture still looks all right. There's no obvious cracks in the real economy. I guess the vulnerability lies more in terms of the sensitivity to valuation, which is kind of separate from the economy itself, although it's interlinked, of course. In terms of rate cuts, so we have had 6 rate cuts from the Fed, 3 in 2024 and 3 in 2025. In total, I think it's about 1.75% cut. That's been quite a lot of cuts. Going forward, of course, the views diverge across different market participants, but collectively, if you look at the latest, the futures market, which reflect market expectation, the market overall is expecting less than 2 cuts in 2026. So there is definitely an overall expectation that the rate cut speed and magnitude is slowing down and is kind of coming to an end, all else being equal, because you never know what new information we will get in the future. Next page, please. And going to fixed income, this is again a very useful chart to help us see where we are across the fixed income sectors in terms of its yield and versus the historical level. So the purple bar shows you the historical average, And with the recent reset of rates, the yield level, the absolute yield level across most fixed income sectors is still way above historical average. And again, that is quite attractive for fixed income investors and a good thing, although the window is probably slowly closing as the rate declines further in the future. Yeah. Moving on to the next page. So now, moving away from fixed income, we have seen a lot of questions in this webinar and also in the previous market outlook webinars. People are worried about how the equities market is going to do. And I think there's a huge temptation to time the market and to think that you have more information than other participants in the market. So this chart I found very interesting. Essentially, Bloomberg publishes 13 forecasters forecast on S&P 500 every year. And the table is not their forecast, is the difference between their forecast to the actual realized return of S&P 500 for that year. And the difference is actually really big. So you can see the best forecaster in the best year of his forecasting had a difference of 7% between the forecast and the realized equity performance. And it just shows how difficult it is for anyone to predict stocks market performance in a given year. Next slide. And this is a slide that kind of Hugh touched upon already in terms of hedging, because we have been, I guess, receiving questions concerning the US dollar versus Sing dollar volatility. And it's a real I guess, question, because it does affect your return. And, I think all of us are going through this in a very personal way. So as you mentioned, we actually want to view it from a very rational perspective and from a long-term perspective, based on evidence. So we do offer, actually, I would say all, if not, almost all of our fixed income funds in Sing dollar hedged format, because we do believe that it adds value to our investors and it makes a huge difference to your investing kind of experience. The reason, a key reason, is the relative volatility. So people invest in fixed income for stability, but currencies is inherently a lot more volatile than fixed income. And if you have exposure to a foreign currency, you're adding that layer of volatility to your portfolio. So if you look at the bottom chart, the gray line is your bond return if you did not hedge. And it's very volatile because you are exposing yourself to the currency risk. And the blue line is if you have hedged. Hence, we do see the value of hedging for fixed income. Whereas for equities, actually the difference is not that big. Most of your portfolio's volatility will still be driven by the equity risk premium. Hence, we only offer select options for select hedged options for our equities funds, and for particular reasons, right? Sometimes the fund manager don't have a non-hedged share class, so there is no option but to go for the hedged share class. And actually, a lot of the equity funds within our income portfolios are hedged. The reason is because we want to preserve the stability of the income stream for these income-generating equity funds, to be protected from the FX volatility. So for very particular reasons, that is aligned to the objective of the fund. Maybe we can move on to the next slide. Sorry, I'm jumping around a bit, I realize. But just coming back to, how timing the market can be really costly I think this chart is very powerful. So it basically assumes an investor in different scenarios who invest $10,000 in the beginning of the century. And if you just kept invested in a globally diversified market, you would have gained, 6 plus 6.8% on average on an annual basis. And your wealth would have grown more than 5 times as of end of 2025. However, if you wanted to time the market, you pull the money out and you wait. You think you'll catch the bottom. But we know how recovery happens in the most unexpected way. And actually, recent year, we have experienced V-shaped recovery, for example, after tariff. So if you missed the 10 best days in the equities market, you would have lost $24,000, more than $24,000. And if you missed the 50 best days in the market, your return would be negative over the 25 years of investing. And the best days are only 0.16% of the overall trading days. It just shows you that it can be really costly to want to wait and time the market. And here we often, remind our investors that, volatility is expected when you are investing. So ensure that when you put down your investment, you are okay with the volatility. Therefore, you won't fall for one of the worst behavioral trap, which is sell when market is going down and buy more, and kind of follow the momentum and go back to the market after the market is recovering. Yeah. Next page. So yeah, very simplistic way of representing different mindset of investing. You can spend it, or you can save money, or you can speculate, or you can invest for future needs. And that is what Endowus is here for. We help you navigate through the markets and actually invest well to live well. Great. So that concludes the main part. We can take some questions.
Yeah, thank you, Yulin. I'd like to take a first question, which is the question was, based on the changes seen in the industry and sector performances, has Endowus done any changes to the core and core enhanced portfolios? First of all, core enhanced portfolios is an AI portfolio, so we're not able to mention in this particular webinar. But I think the principles are pretty similar, so I'll just do a broad explanation, which is that Endowus does not do tactical asset allocation, meaning we don't take views on regions, sectors, asset classes, etc. We're here to create the most, cost-effective and sensible solution to meet your goals, right? So it's essentially the core portfolios are evergreen portfolios that you don't have to change too much, depending on the view of your economic regime and so on and so forth. So just to remind you again, it is really a combination of a systematic way of investing through the likes of Dimensional, where it's a completely diversified, globally diversified. It's even more diversified than index funds, by the way. Globally diversified set of predominantly equity investments through a evidence-based lens of factor investing, which has proven that the cheaper stocks you buy, the better the outcome going forward. So value, the smaller companies tend to do better over the long run, so small cap, and then the more profitable companies tend to do better over the long run. So those three factors are kind of what is the main part of that. Then the composition are the cheapest index funds as well to track beta, and then mostly on fixed income, we work with PIMCO, who has proven to have very, very strong active performance over the benchmark over the long run. So the idea of the portfolio is that you don't have to change it depending on the view of growth versus value or even sectors. And I think you may have heard us mention that part of the reason why core Flagship has done well is because of its overweight to emerging markets. And it's like, hey, I thought you said you didn't do tactical allocation. So that part is also, we have an overweight, not because we are tactically overweight emerging market, but it's because our view of emerging market allocation is different from the way the index equity index weights have been composed, we think that underestimates the actual economic value and corporate value of emerging markets. And so that's more of a structural view as opposed to a tactical view. But in any case, these are kind of evergreen long-term assessments that don't change depending on our tactical views. The only times we have changed over the last few years is if there's a clear structural reason to do so. So, for example, in the past, we had used index funds with higher total expense ratios, and we found other index funds with much lower expense ratios for the same exposure. There, we will do a recommended portfolio change and make the portfolio better from a cost perspective, but that does not mean we have a tactical view in or out. The core enhanced portfolio is another portfolio that was designed to improve the risk-adjusted returns using liquid alternatives. Again, if we find better ways to change it, we will do it. But again, the idea is not to be tactical. It's to have a long-term view. And therefore, that's why we have the satellites and other portfolios that clients can choose to express their own views. So for example, if you think that a stagflation is coming, which means growth is slowing down and inflation is sticky, those are periods when real assets tend to do better than normal equities or conventional equities. And that's where you could add a segment of that to your core to express your own views. But we would not change that. Just one last point on core, because I think I saw another question on gold as well, whether we should add gold to our core portfolios. And while we do think that gold plays a very important role, particularly for clients who are worried about dollar debasement and other reasons, because gold is not a yielding asset class, it's very difficult to determine the right weight within a balanced portfolio. And because of that, again, it could be an addition for clients who want to add it to portfolios, but we would not add it into our core flagship portfolios. Yulin, you want to take some questions?
Yeah, there is a question on a very specific one. Why is the market value of Endowus stable income decreasing despite the bond market performing well? I think I just wanted to clarify first. I would imagine that when you refer to market value, you actually refer to the NAV, the net asset value after taking the distribution. So that actually provides a very important segue for me to explain something that's important. I think, firstly, I'm going to stress again, investors eat total return. You don't eat income. And income is just part of the total return. So when comparing to the broad bond market, it's important to compare apple to apple, total return to total return. And if we can go back to the Endowus income portfolio returns, we can actually see that over all time periods, the stable income portfolio has outperformed the bond market. So yes, the bond market is recovering from the 2022 drawdown, and stable income also had drawdown in 2022 because it's exposing to the bond market, but it actually was, first of all, more resilient in 2022. It drew down less, and it's been recovery better in that sense. So I think there is a very difficult truth to stomach, and that is, if you are not reinvesting the income back to your portfolio to compound that recovery, you might be experiencing a much slower recovery to your net asset value after income, right? So we always say that, compounding in the long term is your friend when you are growing your wealth. And the opposite is true. Taking money off the table is actually your enemy when you are trying to recover and compound back. So that's the first point. And this is why in our advisory process, we really emphasize the importance of matching your need to the portfolio. if you don't really need income, you should really not choose the income portfolios or reinvest the income to grow your portfolio for the long term rather than taking money off the table. And a second truth that's quite difficult to swallow, I think, is this idea of a sequence of return. So the experience of someone going into the market and it immediately experience, once in a century drawdown in the fixed income market. That's what happened in 2022. And still taking income from that drawdown because income needs has to be met. It's very different to someone, coming in and fixed income immediately had a good year. So you started off on a really good foot. And it gives you cushion in the future to withstand some kind of drawdown more versus if you entered the market drew down, you started off with a kind of bad footing and it's harder to climb back up. So that because we usually talk about returns in the average term, but the sequence of return especially matters when you're an income investor because you're taking money off the table. So when the market recovers after the drawdown, you have less on the table to recover. So I think those are just some points that I wanted to cover responding to this question.
Thank you, Yulin. I think we're almost out of time. We actually are out of time, but I do want to answer one last question, which was a question on why is your very aggressive equity portfolio underperforming global markets? But I just want to clarify that it really depends on which portfolio you're referring to. But the main portfolio, which is our flagship cash portfolio, has actually, first of all, the very aggressive is the 100% equity. The aggressive is an 80-20. So it has 20% in fixed income. So that's probably not the right comparison. But if you look at the very aggressive portfolio, it's returned 3% in Q4 versus global equities, the same as 3%. And for the whole year, it's the same. But if you look at the second half of the year, particularly as it came out of the recovery of the tariffs, it actually returned better in the second half. And for the whole year, it returns the same with slightly lower volatility. So I think if you think about the way we've constructed the portfolio, again, the core flagship is not designed so that in any given year, the performance should deviate too much from the index anyway. But really the determining factors that determine the performance really is the factor tilts that we've described, which is value, small cap, and profitability, as well as the slight overweight to emerging markets. So that's really it. Now, that has been, I think, a pretty sensible way to construct again, passive and systematic, so not very active portfolio because of concentrations that we're seeing in the market. And when obviously the concentrated stocks were doing all the performance, particularly in 2023 and 2024, having a portfolio like this would have looked like it is underperforming. But if you think about first of all, the absolute returns, and then the volatility adjusted returns, this is, in our view, a much more resilient way to build the portfolio. And even with that, in 2025, and particularly the second half of 2025, it actually outperformed. So we view that on an ongoing basis, particularly as we see this kind of fear around concentration. I do think that this portfolio construction makes sense. So just want to clarify, actually, the flagship did not underperform. It actually, if anything, outperformed slightly, particularly on second half. Some of the other portfolios did underperform. So the ESG and the CPF that Yulin explained underperformed for different reasons. But again, some of the reason is because those are designed that way. And in some cases, having global equities as one benchmark may not be the most applicable in that situation as well. Yulin, anything to add? I think we're over time.
No.
Okay, thank you all of you so much for spending your precious lunchtime with us. Hopefully we've addressed a lot of the concerns in the market. I know it's a difficult period in terms of volatility and uncertainty, but we've seen this movie before for decades, and hope you stay invested and compound wealth over the long run. Thank you very much.
Thank you.
Does holding your investment position leave you sweating? With Endowus, invest with clarity. Proven strategies, unbiased advice, low, fair fees. Endowus.